Food prices continuing to increase and the U.S. corn more competitive against the Brazilian corn. We are going to speak with Mike Zuzolo, President of Global Commodity Analytics. He is back to ConnectedFarmer, your channel to keep you up to date with the latest trends in agriculture and livestock. So, Mike, how are you today? As we speak, we are having reports that confirm a reduced safrinha corn in Brazil, something that we talked many times here.
Yeah, and we're getting to a point now where the trade has settled in and thinks they've priced in adequately the tighter supplies, but I think that's being matched up against the ideas that we have a very good corn crop being grown in the United States, Luis. And I think that especially probably hit the trade and took away from last week's news about the smaller Brazilian corn crop because of the crop conditions for corn coming out for the first time this season at 76% good to excellent. It was on the upper end of what the trade was expecting. And I think the trade is, I don't want to say not understanding that there are some big areas of problems. I think they're just trading very short-term news, and they're moving from one piece of news to the next in trading. And maybe they'll continue to do this until they know that the Northern Plains wheat and corn and bean and canola belt in the United States and the Canadian Prairie Belt is too far gone and it's too far past to help with rainfall in another couple weeks, and that area becomes more like Brazil's corn crop. I'm wondering whether that's not the mindset that we're starting to pick up in the trade. I want to say that it looks to me, because of Brazil's lower corn number, that the world corn stocks to use ratios, instead of being nearly 25%, are probably closer to where we were back in 2012 of around 22%. And we may even be moving towards 20% depending on how this crop year goes. 20% is kind of a threshold. It's a low threshold. That's where we were back in that 2006, 2007, 2008 time period for the corn. And if we would drop down to that level, I think that's where you could open up the upside for the corn market. A lot of producers have said, how do I get $8 corn futures? And I think that's probably the best way to get it, given what's happening in the wheat market, given a ample supply of wheat that looks to be coming on board in terms of winter wheat here in the next 60 days. And so the Brazilian corn crop is a supply issue. The U.S. crop conditions report is a supply issue. Recall that May was broken up roughly in half. The first half was supply driven. That's where we rallied sharply. And then we came back around in the second half of May, thanks to China especially trying to pressure the commodities by changing their policies. We came back around to the demand side of the market. And I think maybe June will be the same type of strategy or the same type of mindset or psychology by the trade, especially if China starts to pick up again on trying to push the market down in the second half of the month after the WASDE report.
And looking ahead for the second half of the year, we will have less corn supply in the world, and yet you are having some help from the Brazilian currency that has been appreciating recently in the latest 2 weeks because of higher interest rates in Brazil and a GDP growth that has been higher than expected.
Yeah, and that's been a real headwind for Brazil. It's been a real tailwind for the United States. We haven't gotten a lot of soybean business from anybody, though. With that, it's really helped the corn market the most. And we continue to see the 2021 sales being reported by USDA. The export sales on Friday will be very important, like it was last week, to see if China's done any cancellations. That's always going to be something that I'm going to have to watch here, because China like most countries, especially those that import food, do not want higher food prices. And I've never heard anybody come back from a grocery store, and you probably never have either. It says that comes back from saying, "Oh, I'm so mad that steak price was so low. I wish they'd charge more." This is where we're getting into lofty prices. And I think what we have to watch now in the currencies is to see whether what happened on Thursday's trade here in the United States, where we saw put up against each other economic data where China looked like it was slowing down in their purchasing managers index compared to last month, and especially compared to the past several months. And then we had really strong employment gains from a private survey here in the United States from ADP. That seemed to create some inflationary fears here in the United States, and that tripped the dollar to the upside, and we saw some strong short covering. And in one day, we were able to get back to levels not seen since the middle of May. So we erased about 20 days of losses in the dollar just on Thursday's trade because of this difference in data. And this is where your Brazilian commentary really comes into play, is that the financial markets are going to work really hard on buying the currencies where the interest rates are the greatest. And I think the trade is starting to think maybe the Federal Reserve here in the United States is going to have to move more quickly on raising rates because of the core PCE index being above 3% on an annualized basis. And then just this week, we saw the United Nations Food and Agricultural Organization put out fresh food price numbers. And those food price numbers were up 40% versus the pandemic back in May 2020. And for the month of May, they were 27% above the average between 2014 and 2016. Probably most importantly, those food prices that they measure were at the highest level since February of 2011, and they've gone up 12 consecutive months, Luis. So we have got food price inflation, and I think it's safe to say, and I'm going to go on record in saying it's not transitory. It's going to stick around for quite some time because of what's going on with things like the cyber attack on JBS. This supply chain is still an issue, and it's going to keep, I think, food prices very elevated through the summertime.
Yeah, so we are seeing a lot of reopenings around the world, but there are some back and forths about this, and we are not sure on when the whole world will reopen.
Yeah, you bring up a really massive point, because we're trying to game out and time out when consumers who have extra money from the pandemic fiscal stimulus and extra unemployment dollars from being unemployed, when that money will run out, and they'll start to feel very abruptly and shockingly their food and energy prices and their overall costs go sky high, because it won't feel as good because they're not having as much revenue come in to meet that higher inflation. And I was talking to an economist over the weekend at my daughter's wedding reception, and we were talking about exactly this. In fact, I talked to several people about it, and one of the people I talked with, who was an economist, said, it's interesting, we will probably see the unemployment numbers, benefits run out in around August, and a lot of the stimulus probably run out around the September, August time period as well. And I found that very interesting, because that's also a time period where you either have the crop made here in the United States and the rest of the Northern Hemisphere, or you don't. So the question I continue to ask myself is, in 6 months from now, will demand be higher or lower? And I think it's pretty safe to say, given these prices and given what I just said, it's more than likely demand will be lower. So I still believe, like May, we want to sell as the market goes higher, or at least hedge or buy puts, get hedges in place, get floors in place in case this demand gets hit harder than what maybe we're expecting, in case that weather does end up coming back around.
And I think the context is easier for the grain farmer than for the livestock producer.
It's going to really be tough on the cattlemen around the world. I don't care where you're at. It's going to be expensive feed. If you're in a drought area, it's going to be hard to gain, and your animals are going to suffer. Your weights are going to be tough to build. I just see this, and then you have the cyber attacks and the high food prices. The cattlemen are on the front line with that. One thing the hog producer has, at least, is a very low soy meal price. When you look at a hog meal ratio chart, I think you're up at around a 6-month high right now because hogs keep going to new record highs in some of these areas for prices, and we still have disease pressure in the hogs. And so at least the hogs are making it on the sale price to offset the high corn price. And the meal price is still very, very tame at this point because the bean market has been led by the soybean oil, that food category, not the feed category. But I think the cattlemen, especially globally, whether you're in Argentina, whether you're in Brazil or the United States or Canada or Australia, you're going to have to really be tough, really a good marketer and a good hedger between now and August. USDA is suspecting or expecting the third quarter to be the peak in the U.S. beef production here in the United States. I agree with that based upon the quarterly numbers, or based upon the monthly cattle and feed numbers, I should say, and the biannual numbers. And we'll get another biannual report here in about 6 weeks or so. It's important, though, I think between now and August, we really want to hedge and make hedges and sell into this market on the cattle. If we can get another $6 to $8 higher in the August contract, another $6 to $8 higher in the December contract. And, I won't hedge as much after August, but probably still will want to put a little bit on the books if we get to the right price in December.
And given this high price of corn, do you think that the wheat would be more used as a feed meal by other countries, not just China?
Yes, I think that's exactly right. Here in the United States is going to be a perfect example. Illinois has just completed a soft red wheat tour in that state, and they published their findings just today. It looks like they are getting yields that may be able to rival their record yield of 75 bushels an acre back in 2017. So the cash price of wheat, I think, will be very low in the month of July and August compared to the cash price of corn, whether you're talking about soft red winter wheat or hard red winter wheat. So I think the winter wheat people and cattlemen, if they have bad stands of hay or bad pasture, they will at least have, I think, some wheat to be able to buy and not have to buy expensive corn. It's the northern plains and the Canadian prairie cattlemen that are probably going to suffer the most because that's spring wheat country, and it looks very dire up there at this point. If they go another 2 weeks without rain, as I said earlier in the conversation, I think you could start to classify North Dakota and South Dakota and the Canadian prairies directly north of them very similar to Paraná and the Brazilian corn crop as far as what kind of damage we may be looking at.
Are you detecting already a huge volume of losses there?
Yes, and in fact, I talked to several clients and colleagues in that area. Freeze damage is noted from late last week, both in corn and in soybeans. And there are producers in North Dakota that are just not going to sow or plant spring wheat at this point. And they're probably going to wait to try and get a rain and then put soybeans or canola or sunflower seed into the ground instead of the spring wheat because they're hurting that badly. So yes, it's as bad as 2012 in that area of the country from what the maps are looking like to me, Luis.
Yes, many factors that are contributing to the upside down.
Yeah, the outside markets I think are going to continue to be China and the US dollar. I think one of the things that maybe I didn't talk about very much here in this program as much, but I want to hit it really hard is we saw at the end of May China try and push down commodity prices by changing policy. The beginning of this week, they changed their currency policy to try and weaken their currency because it hit a 3-year high against the US dollar, and they're just not exporting enough. I think their economy is stalling out at this point, Luis. So don't expect the Chinese not to continue to do this. In other words, the Chinese, I think, are going to try and pressure these markets all the way through the summertime, and they'll probably still buy because I don't think they have the stocks or the supplies that they had back in 2013 when they did this before. They pressured the market by not taking a certain genetic, certain GMO type corn. And it wasn't as big a volume as what we're dealing with them right now, but it was about 25% of our corn imports they ended up not taking that year by December of 2013. I think they'll continue to really pressure these markets as much as they can through their policies and through their rhetoric. So don't assume that China is not going to do that. I think it's going to be the exact opposite. And again, it goes back to if you get profitable in these markets, and I know you don't know your yields, at least get some floors underneath you with some bought puts. If we can get back up into those that old high area in December corn and November beans, that's my game plan. And as I said at the top of the show, I'm hoping that we can do that before the half of June is over with, and that we have a rally that's supply led thanks to Brazil and thanks to the spring wheat market. And if we can get that rally, then take advantage of it.
Thanks a lot, Mike, again.
Nice to be with you, Luis. Thanks for having me.